What if I told you there's a simple checklist Warren Buffett uses to turn good ideas into billions, and most investors never even think to use it? Buffett's approach isn't about guesswork. It's a proven, four-step filter to find the best stocks and avoid the worst. In this video, I'll walk you through each of these 4 questions and show you exactly how Buffett uses them to build wealth that lasts. Watch to the end, because once you understand these, you'll see investing through a whole new lens. When Warren Buffett looks at a stock, the very first question he asks is simple but powerful. Is this a business I understand? This idea is what Buffett calls staying within his circle of competence, only investing in companies you truly understand, inside and out. Not just what they sell, but how they make money, why customers choose them, and what might impact their future. Let's take a classic Buffett example, Coca-Cola. Buffett has owned Coke stock for decades. Why? Because it's incredibly easy to understand Coca-Cola's business model and its industry. Coca-Cola makes money primarily by selling concentrates and syrups to bottling partners, who then manufacture, package, and distribute the finished drinks. Coca-Cola doesn't do most of the bottling and distribution itself. Instead, it sells concentrates and beverage bases, or the thick syrup, to licensed bottling companies around the world. These bottlers mix the concentrate with water, carbonate it, bottle it, and distribute it. Coca-Cola earns money upfront by selling these concentrates. Additionally, this business model is high margin because Coca-Cola avoids the capital-intensive parts of the value chain, like bottling plants and trucks. You don't have to be a genius to understand this business and what drives it. Billions of people around the world drink Coca-Cola products daily. The core product hasn't changed much in over 100 years, and its global brand power is unmatched. Buffett doesn't have to guess what Coca-Cola will be doing 10 years from now. It'll still be selling beverages with strong demand and pricing power. That kind of business is firmly inside his circle of competence. Compare Coca-Cola to a company like NVIDIA. NVIDIA is outside of Warren Buffett's circle of competence because it's in a fast-moving, highly technical industry. The company makes advanced computer chips used in things like artificial intelligence, gaming, and data centers, areas that are hard to predict and require deep technical knowledge. Buffett prefers businesses with steady, easy-to-understand earnings. While NVIDIA is a leader today, its success depends on constant innovation and staying ahead of tough competition. That kind of uncertainty makes it hard for Buffett to confidently estimate the company's future, so he tends to stay away from companies like NVIDIA. Before you buy any stock, ask yourself these 3 questions. Can I explain how this business makes money in a few simple sentences? Do I understand its customers, competitors, and industry? Can I predict with some confidence where it will be 5 to 10 years from now? If the answer is yes, it might be worth digging into deeper. If the answer is no, move on. There are thousands of other fish in the sea. Because when you stay inside your circle of competence, you protect yourself from avoidable mistakes and put yourself in a much better position to find long-term winners. If a stock passes through Buffett's first filter of being in his circle of competence, it moves on to a second filter. Does this business have a moat? One of the most important things Warren Buffett looks for in a business is a durable competitive advantage, what he famously calls an economic moat. Think of a moat around a castle. The wider and deeper it is, the harder it is for enemies to attack. In business, a moat protects a company's profits from competitors. It's what keeps customers coming back, allows the company to raise prices, and helps it earn strong returns year after year. Buffett isn't interested in companies that are just doing well right now. He wants businesses that can stay strong and even get stronger 10 or 20 years into the future. That's where the concept of an economic moat comes in. A moat can come in many different forms, but here are Buffett's 3 favorites. The first type of moat is brand power. Take Apple, one of the most powerful brands in the world and Buffett's most successful investment of all time. Millions of people choose Apple products not just for the specs, but because of the brand experience. The design, the simplicity, the ecosystem. Owning an iPhone or a MacBook isn't just about technology, it's a lifestyle choice. That brand loyalty allows Apple to charge premium prices and keep customers coming back year after year. The second type of moat is switching costs. Switching costs are another kind of moat Warren Buffett loves, when it's difficult or risky for a customer to switch to a competitor. Take the company Moody's, for example. a business worth $85 billion that Buffett owns 14% of. Moody's provides credit ratings, like financial report cards for companies and governments that want to borrow money. These ratings help investors decide how risky a bond is. If a company has always used Moody's and suddenly switches to a smaller, cheaper rating agency, investors might get nervous. They might wonder if something is wrong and demand higher interest rates. That fear alone makes companies stick with Moody's, even if it charges more. That's a switching cost. Customers aren't trapped, but leaving comes with real consequences. And that gives Moody's pricing power and long-term staying power. Exactly what Buffett looks for. The third type of moat is network effects. The more people use a product, the more valuable it becomes. That's called a network effect. American Express is a global payments company that makes money by issuing credit cards and by charging a fee to process transactions on its own network. Buffett has a 22% stake in the company, worth a staggering $45 billion. American Express, for example, has millions of cardholders and merchants in its network. The more cardholders it has, the more businesses want to accept it. And the more businesses accept it, the more people want to carry it. That creates a self-reinforcing loop, a moat that gets wider over time. The key to a great investment in Buffett's eyes isn't just finding a profitable business. It's finding one with a moat that lasts. Plenty of companies do well for a few years, but without a moat, competitors will copy them, undercut prices, and steal market share. Buffett avoids those. So when you're analyzing a stock, ask yourself these 3 questions. What makes this company hard to compete with? Why do customers stick with it? And most importantly, will that still be true 10 years from now? Once Buffett finds a business he understands and believes has a durable competitive advantage, the next question he asks is, does this business have strong and predictable financials? Why is that so important? Because no matter how exciting a company may seem, Buffett wants to invest in businesses that generate consistent, reliable profits year after year. That consistency gives him the confidence to hold them long term and ride out short-term market noise. Let's break down what Buffett means by strong financials by looking at 2 of the key financial metrics Buffett analyzes before making an investment. One of the things that Buffett looks for in a company is high return on equity, or ROE for short. ROE measures how efficiently a company uses shareholders' money to generate profits. If a company earns $20 in annual profit on every $100 of equity, its ROE is 20%. That's a sign of a high-quality business. Buffett especially likes companies that can maintain a high ROE without taking on excessive debt. Let's take Visa as an example, a company Buffett has a multi-billion-dollar investment in. Visa's business model is built around operating a global payments network that facilitates digital transactions between customers, merchants, and banks, earning revenue by charging fees on each transaction without taking on the risk of lending money. With minimal physical assets, Visa earns extremely high returns on equity, often above 30%. It doesn't lend money like a bank. It simply facilitates transactions and takes a cut, making it capital light and highly profitable. That's exactly the kind of business model Buffett loves. The next thing Buffett loves to see in a company is strong free cash flow. This is the cash left over after a business reinvests in itself. This is what a company can use to pay dividends, buy back stock, or grow strategically. Apple is a prime example. It generates tens of billions in free cash flow every year, which it uses to reward shareholders through buybacks and dividends. It's one of Buffett's longest holdings because its financial engine is not only massive, but highly consistent. One way to measure how effective a company is in cash is to compare its free cash flow to its revenue. This is what is known as a free cash flow margin. In fiscal year 2024, Apple did $391 billion in revenue and generated $109 billion in free cash flow. This is a free cash flow margin of 28%. To truly grasp just how impressive that number is, let's compare it to some other blue chip stocks. Nike had a free cash flow margin of 12%, General Motors of 7%, and Walmart just 2%. With this perspective, it's easy to see why Buffett was willing to make Apple his largest ever investment. At the end of the day, Warren Buffett isn't looking for the most exciting business. He's looking for the most dependable. A company can have a great product or a strong brand, but if the financials are shaky, it doesn't make the cut. Buffett wants to own businesses that throw off steady, reliable cash flow, earn high returns without excessive debt, and have the strength to keep compounding year after year. Strong financials aren't just about surviving downturns. They're what allow a company to take advantage of them. Warren Buffett often says, "Price is what you pay, value is what you get." That one line captures the essence of his fourth and final filter. Only buy a great business at an attractive price, a price that offers a margin of safety. But what does that actually mean? To answer this, you must know the difference between intrinsic value and market price. Every business has something called its intrinsic value. That is the true worth based on the cash it will generate over time. That value does not show up in a stock quote, but it can be estimated by looking at the company's earnings, growth potential, and financial health. Buffett compares this to buying a farm. You wouldn't pay based on what someone else would pay tomorrow. You would look at how much money the farm will produce year after year from crops and livestock. Stocks are the same. If a company is worth $100 per share based on its long-term earnings, Buffett doesn't want to pay $100. He wants to pay $70 or $80. Why? Because even the best businesses face uncertainty. Recessions, disruptions, mistakes. Buying at a discount gives him a cushion if things don't go exactly as planned. That's the margin of safety, a buffer that protects you from downside risk. Buffett doesn't rely heavily on price to earnings or PE ratios or technical charts. Instead, he thinks like a business owner and asks himself these 3 questions. What would I pay to buy the entire company? How much cash will it generate over the next 10 to 20 years? What's a reasonable discount rate for those future earnings? Let's take Buffett's legendary investment in Apple as an example. This turned out to be Buffett's most profitable investment ever, making Buffett's firm over $100 billion in profit. Nobody guessed that would have been the case when Buffett originally made the investment. When Buffett bought Apple starting in 2016, it wasn't because it was trendy. It was because, at the time, Apple was trading at a modest valuation relative to its cash flow, had a massive cash pile, and was buying back shares, effectively increasing Berkshire's ownership over time. The business was strong, and the price gave him a clear margin of safety. That's why Buffett doesn't just buy businesses, he buys them at prices that leave room for the unexpected. And that margin of safety, that discipline in how he invests, is what sets him apart. If you want to build that same discipline and margin of safety into your own investing without spending your nights and weekends buried in financial statements, check out the link in the description. We've created something called Investor Center Research, a monthly stock research service where we break down exactly how we're finding and valuing the kinds of businesses that fit Buffett's investment framework. Each month, you'll get one high-quality, mispriced stock idea, vetted by our team of professional investors with Wall Street, private equity, and venture capital experience. You'll see how we analyze them, what price we're willing to pay, and how we're building real positions. Not just theory, but practice. We're launching in just a few weeks, and there are only 250 founding member spots up for grabs. These folks will lock in our lowest ever price for life. So if you want to secure one of those spots and get early access to the research, join the waitlist today. And if you're watching after we've already launched, that same link will take you straight to the product, where you can see exactly how it works and get started right away. Either way, when you sign up today, we'll also send you a free copy of our Warren Buffett investment checklist, a simple, powerful framework you can use to evaluate any stock like Buffett does. If you enjoyed this video, you'll love the checklist as it goes deeper with 25 timeless questions Buffett uses to evaluate every stock he considers. So hit the link in the description, get the checklist, and start investing with confidence, like Warren Buffett would. Thanks for watching, and I'll see you in the next one.